Good evening, everyone. Greg McDermott with Cyber Trading University, welcoming you to our webinar this evening, The Options Advantage. Looking forward to talking to you about options, the advantages you have while trading options in a world that you're probably familiar with from the equity side. So we are going to get moving right away. Our first few bits of business, the CTU risk disclaimer. Please take a moment to read through this. Next, about Cyber Trading University. CTU has been an educational trading institution since 1995. CTU established itself as a leader, first by working directly with the SOES trading firms to teach them to day trade. Cyber Trading University was one of the first to establish itself as a quality stock market trading school. Each of our instructors, including myself, has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders. The CTU headquarters are located in the heart of the trading world in New York City. That's me, Gregory McDermott. Earned my master's degree of applied finance from Macquarie University in Sydney, Australia. Bachelor of Science in Financial Management from St. Joseph's University. Crude oil options trader at the New York Mercantile Exchange. Head options market maker for JAS Securities at the Philadelphia Stock Exchange. I manage the firm's portfolio risk for our team of 10 options traders on the floor at the Philex. Was a market maker in Dell Computer at the Philex, which at the time was the busiest equity option traded in the U.S. I also directed our off-floor trading unit for JAS Securities, and I qualified with the International Securities Exchange as a DTR. This is the question you're probably asking yourself. This is probably the reason you're with us this evening. And we're going to talk about it. Why should you trade options? Why is options something you need to add to your trading toolbox? And what we're going to talk about, there are a number of reasons why, and we're going to go into those tonight in detail. We have the capital efficiencies, the ability for trading with limited loss and risk reduction. Yes, I did say risk reduction. It's a superior alternative to shorting stock. Additional means to profit. There are greater choices when trading equities, position integrity after profit taking, which is a key feature of options trading. Timely and flexible portfolio protection. There are income generation methods and the ability to cancel out the noise in the market. We're first going to start at the top of the list with capital efficiencies. And that's one of the, to me, the cornerstones of the ability of options to allow you to become a better, more well-rounded trader, better managing your money and your risk. When we talk about equities, and I'm assuming that most of you come to us from an equity trading background. And let's be clear, I'm not saying that the only reason you should trade, and some people misconstrue this part. Well, let me go through it, and then I'll explain to you what I mean. Let's look at an example. Let's say you wanted to buy 100 shares of our fictitious XYZ stock, trading at $100. What's that going to cost you in your account? Well, that's $10,000 of your equity tied up to own 100 shares of XYZ stock. Or if you bought one January 100 strike call for $10, that would take $1,000 in equity out of your account. It would allow you, these are call options, would allow you the right but not the obligation to buy 100 shares of XYZ stock for the price of $100 until our January expiration. What's the difference there? That's a 90% discount or a 90% savings in your trading account. Now, I do want to make this point. I'm not saying that the only reason you should trade options is to allow you to trade and leverage your account, whether it be by controlling more stock or by trading higher dollar stocks. But let's be honest, if you wanted to trade 100 shares of Google right now, closed just a heartbeat under $585, I mean, to have 100 shares of Google right now, it's going to cost you $58,000 in your account. That's a lot of money to be tying up, and we're going to talk about some of the risks that are involved in that. So it does allow you the ability to leverage your account. It does allow you maybe to trade stocks that might be dollar-wise priced, and therefore more volatile, which might be better able to trade. Google, for example, has been moving around the last few days. I happen to have a very, 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 very small position in it, and in options. And I'm not recommending you buy or sell Google. Let's be clear about that. But let's just put it like this: I couldn't afford to have the stock position that I have on in options. And again, it's not the only reason that you would trade options, but it clearly is an advantage. What would you do with the extra $9,000? Well, you could deposit the money and earn a little interest. You could invest with options in other companies to expand and diversify your portfolio. You could also simply use it for alternate risk investments. You could take that money and not have to have it in your trading account, or you could, again, put it somewhere else. But you're able to control for a limited period of time the exact same amount of stock with a lot less at risk. So it allows you to reach beyond your and leverage your account. Now, let me be very clear. I don't want you to confuse leverage with trading beyond your means and your capital plan. That doesn't mean that you take all the money in your account and you push it to the center of the table because as if you were playing poker, because we're not gambling here, and we don't want you to go beyond. You still have to develop risk management tools, but by being able to use options, it allows you to open up more trading possibilities with stocks that trade at higher dollar values. The same strategies can work, and you don't need to worry about the dollar value of the stock being something that precludes you from a trading opportunity. Again, we're not saying you want to go out and be leveraging your account to the hilt, but it does open up more trading possibilities, allowing you to trade higher dollar stocks and allowing you to keep even lower dollar stocks, more money in your account to control and profit with the same number of shares. Let's look at a scenario and watch how this plays out. In scenario one, we have a stock position. We bought that 100 shares of stock. Pardon me, the stock's $58, 1,000 shares of stock. The stock is trading at $58.53. In scenario two, we purchased the October 55 calls. Those calls cost us $3.90. For those of you unfamiliar with calls and puts, come to us with a real basic or maybe no knowledge of options. The call option gives the buyer the right but not the obligation to purchase, in this case, for every contract, 100 shares of our stock. Let's call it XYZ stock. Price is $55. And that option is good until the expiration in October. For example, our September expiration is coming up this Friday. Today, we have 2 more trading days in this normal trading September cycle. So it would be the next trading cycle. You'd have the right but not the obligation to pay $55 for the stock. Now, at expiration in October, in our scenario, we have 2 different things that have happened. What would happen if the stock closes at 60? Clearly looks like a good thing for everybody. And what happens if our stock closes at 55? And we're going to go through those 2 likely scenarios. One, first, we're going to, we paid $58.53 when our stock closes at 60. Therefore, in our stock position, getting a 2.5% return on our invested capital to buy stock at $58.53. In this case, the October 55 calls, we paid $3.90. At expiration, those 55 calls would be worth $5. And on a percentage basis, we would have returned 28%. That's a good percentage return, but it is still just $1.10. So let's be clear about that. Let's not get fooled by the percentages. It does allow you leverage, but is that always a good thing? What happens if we pay $58.53 for the stock? It closes on expiration at $55, and we have to sell the stock. What do we have there? Well, we have a 6% loss. What about our October 55 position in the calls that we bought, paying $3.90? Well, they went to zero. So we had a 100% loss in our position in the calls, although the dollar amount was relatively even. Remember, with all things equal, probability to lose on decay if you're renting, but you can still win if your price level moves up. You do need movement when you own these calls. So leverage can work for you. You know, the cash differential between these two, not really great. The percentage loss looks a little daunting. But where you really come up with an advantage is what we're going to talk about in our next section, which is about risk management. So this shows you what you have from a leverage standpoint. You're able to leverage percentage-wise bigger losses, bigger gains because of the absolute value of the option. Now we're going to take that example, carry it forward to a position where limited loss and risk reduction is inherent in our option trade. Now let's assume that stock we just traded at $58.53 goes Enron. What do I mean by that? For those of you that don't remember Enron, Enron's a stock that was an extremely high flyer on the NASDAQ and cratered due to accounting regularities and misdeeds by the management at Enron. So if the stock goes Enron, and again, stocks don't always, in fact, very rarely do they, but they can. And that's what you need to be concerned about. If your stock goes Enron, we owned 1,000 shares of stock. So we have a $58,530 on the table if our stock is currently trading at $58.53. Our call position, we own 10 of those calls for $3.90. Let me just show you that math real quick so we understand what those calls are. So it was, the price of the call was $3.90. And we owned 10 of them. And how do you figure out the price of one? Let me just do it this way. Let me cross this off for you. If you take $3.90, you multiply it by 100, because that's the number of shares that you have. So what's that? 390 for each option times 10, and that gets us our $3,900. What does that give us the right to do? That gives us the right but not the obligation to buy the underlying stock at, and I'm trying to get rid of my pen. There we go. Erase all drawings. Now we're back. What's the most we can lose in this position? Well, unfortunately, it's the full investment. And in the call, although $3,900 would be painful in anybody's trading account, $58,530 would be, or could be life-changing or devastating to some people's accounts. I tell you, it would be for me. So you have to understand that there needs to be a way for you to limit your exposure. And I'm sure there's some of you right now that are saying, Greg, why wouldn't you just put a stop order in? And then you'd be protected, because my stop order would protect me from the downward move in the stock. Well, in theory, that's true. The problem that you have is that in theory, trying to find, I lost my mouse. Hang on a second, guys. I'm trying to find, there it is. Sorry, I lost control of the mouse. Sorry, let me get this back up for you there. So, and what I mean by that is most people would say, well, Greg, I'm going to use, I would have a stop loss if I had that 55, if I had that $58.53 stock, I would have a stop loss at, say, $50. So I'm protected because my stop loss says I get to sell stock at $50. And it's one of the great misconceptions of trading. But if you have a stop loss, and what is a stop loss? Stop loss order is an order in this case that most people believe is an order that means you get to sell at $50 when the stock trades there. The reality is a stop loss order is a standing order that once the underlying stock trades, in this case, at or below that price, the stop loss is triggered and your order becomes a market order. And let's say that in our horrible Enron-esque scenario, the bad news comes out. And not only do we find out this XYZ stock, not only does it not cure cancer, because it was an imaginary pharmaceutical stock, I just thought of that right now. Not only does it not cure cancer, but it's given cancer to anyone who's ever owned the stock. Clearly an absurd premise, but the stock goes crumbling down. Well, when does this news come out? More often than not, while the market is not open. And if the market is not open, and you have a $50 stop loss, and let's say the first print the next morning when the markets get up, let's say the first print of the stock is $10, and the next print of the stock is $10. If you have a $50 stop loss, where did you sell your stock? In this scenario, when the market was closed, if you are feverishly typing $50 in, you would be incorrect. You sold your stock at $10 because this $10 trade triggered your stop loss, turned this order to a market, and the next place it printed was $10. That's where the bid was. That's where you sold your stock. So you would have, in this case, put yourself into a gigantic loss, losing $48,530. Again, with a $10 print, you would have been able to sell something. But if it opened at zero, you would have lost it all. Whereas if you owned calls, all you can lose is the money that you put into the table. Now, what I'm talking about is, and we would always be teaching here at Options University, at Cyber Trading University, is that we would never be putting you in a position where you would be taught to trade what we would call net short or be naked short options. You're never going to be short more options than you are long. You're always going to be spread. You're always going to be protected. Your loss is going to be limited somewhere. So in this case, if you own these calls, all you could lose is $3,900. Now, still a lot of money. Still don't want to see a loss, but it sure beats the heck out of losing $48,000 in the scenario that we just laid out. So I want to be very clear. The beauty of options, when you are the buyer of options, or in the case of buyer of options, you can only lose what it costs you to buy your options. You can never come back to you and say, hey, we'd like some more money because the trade went against you. Now, if you're maybe the seller of a spread, it's possible you may need to keep extra money in your account to cover the possible losses. But quick example, if you're short a $5 call spread, vertical spread that you sold for $1, the most you can lose is $4 on that trade. So you know that going in. You can't lose $6 on a $5 call spread in our example. So the ability to know ahead of time where your risk is and where your loss is. And for me as a trader, I always look at things that way. I know people that talk about, hey, I think this currency pair or I think this stock is going here and I'm going to make all this money if it goes here. And my question is always the same. What happens if it doesn't? What's the other side of the trade? Where are you getting out? Where are you stopped out? Where are you protected? And when I'm looking, at a trade, I look at where can I comfortably get out of the trade, and then say, given that risk tolerance, what sort of a profit return do I need in order to enter the trade? If they don't match up, I step away from the trade and you just don't do it. You see it a lot with people trading in currencies, but the same thing happens trading equities and trading options. What's my risk? What's my return? Is that a risk I'm willing to take for the return? And let's be clear, if there are people out there telling you that you should be generating capital, and we'll talk about it in a minute, by selling, ratio spreads and those sort of things, it can be very, very dangerous. And if you don't understand the risk involved, as Warren Buffett so famously said, you can turn these into weapons of financial mass destructions. These are derivatives. They can be tricky, but if you play them from the side of ownership or measured sales, you can limit your losses and hopefully maximize your profits. Let me get our drawings off of the screen. So remember, you could lose only your investment in the stock. That could be a lot more. You have to remember, long options. When I talk about long options, I'm talking about the ownership of options. Long options have a limited risk. You can only lose what you've paid for them. You are immune, as I said, the risk of the stop orders. When things go really badly, owning options is a very secure way to trade. You know your losses. You can hopefully maximize some profits, but you have the ability to sleep at night because you know where your risk is. And as I pointed out, the options don't expire. In our example before, let's say you had bought to protect that position, you had bought the 50 puts for that stock that we owned. What does that do? Gives you the right but not the obligation to sell the underlying stock at 50. Well, if our XYZ stock went to $10, regardless of when it happened, as long as your 50 puts are still have not expired, you have the right to sell the stock at 50, regardless of where it's trading on the underlying, even if it is trading at $10. The guy who sold you those puts, the seller's at risk because they have an obligation. You have the right but not the obligation. And that's one of the ways you could protect a stock position, would be by buying puts against a position. We'll talk about that coming up. But all those things are ways that you can limit your risk, and it's the beauty of options. You know your risk going in. Stock can be difficult because you don't, playing with stops, particularly if you're trying to trade as a swing trader or longer, you can be susceptible to unexpected and big moves. It's always the bad news or the good news rarely seems to come out at noon during the middle of the trading day. It's normally before the market or after the market, so that it ends up severely impacting or can severely impact the underlying price and therefore the options that are traded on those securities. Let's talk about the superiority of trading using trading options rather than shorting stock. If any of you have tried to concern yourself, some of the challenges you face when trying to short stock, there's the margin requirement because you need enough cash to cover what can be excessive margin requirements. Why is that? Because when you sell the stock, you have to be able to, at some point, buy that stock back and fulfill and close out your position. Well, in theory, stock can go to infinity. Now, they don't usually go Buzz Lightyear and go to infinity and beyond, but they can. And in order to make sure that the brokerage house and then is protected, and the exchange where you traded that stock is protected, they're going to require you to put up capital to cover potential losses. And those margin requirements can be daunting. They can be burdensome. They can be prohibitive. They can force you to only trade on the long side because of the potential, depending on the type of account you have. So it does require a lot of money to be able to do that. There are SEC rules, investors not being able to place trades. The uptick rule can be prohibitive, particularly in a market that's moving down in a big way. You could have yourself a position set up where you couldn't get the stock off because you can't get an uptick, and you're limiting yourself to trading half of the market. There's a mentality with stock traders that up is good, down is bad, and one of the beauties of options is it frees you from that apparent logic. The thought that up is good, down is bad is really limiting, and it makes you trade on one side of the world and not open up the short and the long. And I'm a believer that up down movement's what you need. Most times, well, as an equity trader, you definitely need movement. As an options trader, there are times, depending on the position that you choose, where the lack of movement can be to your benefit. But it does allow you to get more actively and aggressively trading on the short side. Some brokers just flat won't let you short. Depending on the type of trader you are, your experience, and your capital, they may not let you short at all, which again only opens up the upside of the market. And just the simple fear that investors have about being short, the potential for unlimited upside risk. Something goes against you. Trust me, I've had plenty of trades go against me, and when a stock's going up and going against you, looking for searching for cover is sometimes can be an expensive and harrowing experience. Also, you talk about most people don't realize that in order to short a stock, you have to have enough stock floated, and your brokerage firm has to borrow that stock from someone who owns that stock. You can't just create a short stock against nothing. I'll tell you an example. When I used to trade on the floor at the forex, seeming like about a lifetime ago, but back when Dell Computer was the busiest equity option traded, Dell used to be what they called a hard-to-borrow stock. There was only so much stock out there. A lot of people were short it, and to be the short stock, you had to borrow it. So every day, the nice lady who worked for our clearing firm, Michelle, would come down and say, and it seemed like this went on for a month or more, she would say, hey, guys, there's $100,000 to buy, which meant $100,000, if we couldn't get squared up by the end of the trading day, somebody was going to lose their short stock. Well, one morning I came in, and my clearing firm had removed my short stock position of 10,000 shares. And the former principal partner of our firm, using colorful language, which I will not use for you guys, called the desk at Spear Leeds, which is now part of Goldman Sachs, and used very, very colorful language, making it very clear to them that they were never, ever, ever to take our, I'll leave out the beeps and blanks that would go in at this point, stock away from one of his traders. And so I was left with a position where I was long 10,000 shares of stock that I didn't anticipate, more than what I had gone home with the day before. Luckily for me, the stock opened higher. I reestablished my short position, made a couple of bucks. The good guys won for a change, and we were able to never have that happen to us again. But it's something that people don't realize, that you just literally, you must borrow the stock to be able to short it. And all of these things make shorting stock rather difficult to do? Well, options eliminates all of these concerns. You can get short by simply buying a put. You can get short by buying a put spread, a vertical put spread. You can get short by selling a call spread. And again, when I mean short is I mean you have a bias for the underlying to move down in order for you to profit. There are lots of ways that you can do it without having to worry about the excessive margin requirements, the SEC rules, brokerage rules, the unlimited risk, and the availability, because you can all of these are available to you at any time without any sort of these blockades, these hindrances, these obstacles to you trading on the short side. And to me, it's the first step, breaking the idea that up is good, down is bad, gives you the first step to move beyond what I call the two-dimensional world of options. Up good, down bad. Just very, very simple. Straight line, your profit and loss simply tied to the movement of the underlying times the number of shares you're either long or short. Options gives you what I like to refer to as kind of the third dimension. It's up and down, but it's also the components that are in the derivatives that allow you to profit or lose, but hopefully profit on different types of things besides simply the movement of the underlying stock up or down. Greater choices, additional means to profit. We just touched on it, but the ability and the ease of trading either bull and bear markets or bullish or bearish positions for stocks that you believe are going up or down. You can purchase call options or purchase put options. Simply go to any brokerage platform. We're brought to you tonight by FXCM. They don't handle options, but I really like using Thinkorswim. It's a phenomenal website. I don't have any affiliation with them other than I've known some of the people over there for a while, and they're very good traders, and it's a great platform for options traders. I use it for the demo account for my teaching, and I have my own account at Thinkorswim. So you can simply buy a call or buy a put as a simple, basic, directional play. Now, which calls and puts do you buy? Do you buy the in the money, the out of the money, or the at the money? Well, that's where the education comes in, and that's what we'll talk about in Phase 1, Phase 2, and coming up at the end of the month, actually the first couple days of October, we're going to be teaching Phase 3, which talks about the cool things that everybody likes to learn about, the butterflies and the iron condors and the vertical spreads and the ratio spreads and the calendar spreads and all those kind of things. We're going to spend a good deal of time first couple days in October talking about that stuff. There are other hedged, and they're the ones we're talking about, hedged bullish and bearish strategies, whether it be vertical spreads or calendar spreads or ratio spreads. As long as you're not net short options, there are plenty of opportunities and ways to capitalize on, either lack of movement in the underlying or excessive movement, whether it be the simple passage of time decay or the imbalance in volatility between 1 month and another or one strike and another. Like I said, you can trade the lack of movement. Stocks, normally what you'll find is you'll see like a little bit of movement, and then they trade sideways for a while, and then boom, a little bit of movement. If you look at the chart, there's lots of time where the stocks don't do anything. Well, you can develop strategies, trading options, that will allow you to benefit from the passage of time and the relatively still underlying market. In the class that, in the cyber group that we have, I go in every day around noon. We talk about FX and currencies. In August, I pointed out to everybody that the way options expiration set up, the options expiration for August was August 15th, which meant it was a short expiration. It's the middle of the summer, normally relatively quiet trading period, and we were able to put on some out-of-the-money vertical spreads, selling them, collecting the premium, banking on a relatively quiet market, which happened, and we rung up a number of winners on that, because we knew that there was probably going to be relatively quiet. We knew that it was going to be not much movement in the underlying because of the time of year, and we were able to benefit from it. You also can trade the simple volatility. Now, we'll get into this in our classes, but the way that you price an option, there's a lot of pieces that are relatively static and known. Volatility is the piece that is the, I guess you would call it sort of the art as well as the science. And it gives you, what does it really tell you? Well, it tells you as a percentage how much does the underlying stock move. The volatility number is annualized, so it will tell you if you have an annualized volatility of 20, what should you expect that one standard deviation move, you should expect about 20% up or down in any 1 year with about a one standard deviation or 68% confidence. So probably not going to move a lot. Something that's got an 80 volatility means that it moves a lot, much more movement. And you can trade volatility either directly by using something like the VIX, or you can trade the apparent or the real or perceived differences in volatility between a stock or multiple stocks. Sometimes you may trade one stock that's correlated to another. One may have a high volatility versus a low volatility, and you can develop strategies to take advantage of trading this piece that builds option value, and it's called volatility. And as I noted, simple passage of time. Everybody's heard of butterflies. Well, that's one of the things that you can trade as a way to try to put yourself in the position to benefit from the simple passage of time. Why is that? Well, at their core, options are on the clock. They have an expiration date. And every day that you own an option, the option is worth less than it was worth the day before, all things equal. Why is that? Because every day you're 1 day closer to expiration. And the closer you get to expiration and the less time that you have, the less opportunity that option has to go in the money or more in the money or out of the money or more out of the money. Think of it as more time to move from where it is now. Just think about it for yourself. If you had the choice, would you rather have the option to buy, make something up, Google stock at $600 for 2 days, today and tomorrow and Friday, or would you rather have the option to have it until January of 2015? Well, clearly you'd rather have the option until 2015. Why? Because there's more of a chance that it could happen. You only have 2 days if you're trading the September options to get your options in the money and profit. So time is always ticking. You can use it to your advantage, and it's when you're short options, you're just hoping things sit quietly and time passes. And if you're long options, you want to see movement so that your options can go in the money and you can obviously profit. Position integrity after, and I did say after, profit taking. And I love this thing about, this is one of my favorite pieces of options. There are ways to reduce or modify risk within an existing position, so a primary position need not be adjusted. Let's show how this happens. It would allow their investors to change opinions given ever-changing market conditions. You can do position modifications. There are cost efficiencies that keep you psychologically flexible. And with full stock trading, round trips can be costly and pretty expensive. So there are ways to modify. Let's say we gave the example earlier. I think it's coming up here. Let me see. You also allow you to take out the fear of allowing losses, the fear of loss allowing for profits to run. I apologize. Let me just see. And you really can't do this with stock. Okay, what I want to talk about here is the ability to either A, if you had a stock position, use options as a way to hedge it. I guess that's coming up. We'll talk about that in a second. But what I really mean is, let's say you have an option, you buy 10 calls, and the underlying stock goes your way. 10 calls gives you right but not the obligation to buy 1,000 shares of stock at a specific price. Let's say the stock was trading at $47. You bought the 50 calls. The stock's now trading at $55, and there's a couple of weeks to expiration. Well, your 55 calls are worth, pardon me, your 50 calls with the stock at 55 is worth at least $5. But that money is still at risk because you haven't been able to sell out your calls. Well, what you could do is you could sell those 55 calls and maybe buy, pardon me, sell those 50 calls and maybe buy the 55 calls. Do a spread, call that rolling up. You roll up to the 55 line, and then what you'd be doing is selling your 55 calls, which you've now made a good profit on, taking a little bit of that profit, putting it to work on the 55 line, giving you the opportunity to still have the right but not the obligation to buy 1,000 shares of the underlying stock, but now your strike price has moved up to 55. You've put some money in your pocket, you put the rest of your money to work, and you still have position integrity. It doesn't require you to get out, because let's say you own that stock at $47 and it went to 55. How can you make money on that position? Well, the only way to really cash your chips in is literally to cash your chips in. You'd have to put in a sell order, sell your stock, and then you have no position. But with the options, you own the 50 calls, it went to 55, you sell the 50 calls out, you buy the 55 calls, you now own the 55 calls, and they would probably be trading, I'm making up a number, $2. Let's say the 55 calls, pardon me, the 50 calls you owned were trading at $7.50. So you sell your $7.50 calls, you pay $2, you now have put $5.50 back in your pocket. Just for argument's sake, let's say you paid $1.50 for the calls to start. So now you've had a $4 profit, and you still have $2.50 at risk, but it's profit that you've put to risk. You own the 55 calls, and if it continues to go up, you still had 10 calls, so you still own the right but not the obligation to buy 1,000 shares of stock. You're in the position, you're profiting, you're taking money off the table, and you're still fully in the position. Now, you don't always have to do that. You could just take the position off just like in stock, but it does give you the ability and the flexibility to move around the board. I had a position on, and I had I won't go into the details, but let's just say I had an option I had sold, and what I did was the stock went, I was long, I was short a call, and the stock went down a significant amount. In fact, it was Google. And what I did was, while the stock was down low, the one call I was short in this spread, I bought it back kind of cheap, figuring, okay, if it goes back up, this way I'll kind of be able to profit. And I'm a big believer in not necessarily trying to squeeze every penny out of every trade every time. And the reason I believe that is that, you can get burned by trying to go grab that extra 10 or 15 or 20 cents. I'd sold these calls at $3 and let me think. I think I sold them at $3.65, and I bought them back at about 75 cents. So now again, it's a spread against another position. I'd lost on the other side, but I took this short off so that I was eliminating some of my risk, but I was still in the position. And it's the flexibility that you have with options that you clearly do not have when you're trading equities. And when I talk about equities, I'm just using that as our frame of reference because I know most of you come to us as equity traders, but you can trade options on currencies, you can trade options on futures, you can trade options on commodities, lots of ways to trade options, but we'll just use equities as our example. Timely and flexible portfolio protection. Here's a way, let's say you own stock, or a portfolio of stocks for that matter. You can buy a put to protect your downside exposure. And in this example, if the underlying stock or the portfolio of stocks value decrease, the puts that you own would be gaining in value, hopefully offsetting most, if not all, depending on how you hedged it, all of those losses. If we offset those, we can either protect a portfolio or an individual stock. There are lots of other protection strategies. We had a gentleman out, we had an on-site at CTU a few months back, and one of the gentlemen there was talking about trying to protect his retirement portfolio. He had an S&P 500 sort of correlation position, and he wanted to figure out how could he protect it. And we were talking about how you might be able to buy some out-of-the-money puts as extreme protection for your position in case the S&P would give up and go the other way and cut into your retirement accounts. And again, there's a lot of pieces to make that work accurately, but in general, there's lots of ways that you can protect yourself by using the flexible and very useful options that are out there. And in our example, let's say you bought a put to protect your position. You could simply close out your put and you're back to your original long position. So if you owned 1,000 shares of stock and you bought 10 puts as protection, sell out your 10 puts, what do you still have? You still have 1,000 shares of stock. The gentleman we spoke about, you've got your portfolio geared towards the S&P. You buy some S&P puts as protection when you feel like the water is calmed and you don't need the protection. You sell out your puts. You still have your original position without incurring any of the transaction costs to get in and out, or possibly losing or missing an upside move. And it also, I'm going to hammer the point one more time, gets rid of the unreliable stops, which really more often than not seem to be on the sidelines when you really, really need them. It's like when you're really looking for when you need somebody and you can't find them. That seems like what the stops are when you're out there trading. Okay, simply by closing out a protected put position, original long stock, we just mentioned that is fully intact. It also can preserve or extend a position and help to retain a long-term holding to capitalize on a preferable capital gains tax rate. Depending on how long you've had stuff, you can use options to trade around your original position and avoid taking capital losses or capital gains, depending on how you position it. Again, that protected put is always active, whereas your stops may or may not be. Here's a quick look at an old chart, but you see those gaps. The earnings gaps really seem to happen, again, overnight, and you have to find protection, and the stops are no good at all. Here's one, old example, but it works. November 21st, the diamonds trading 127.79. The January 112 puts were $6.50. If you bought those on January 15th, the diamonds had dropped to 82.18. Those January 112 puts were now worth $29.82. Your profit was $23.82, or $2,332 on every option that you bought. And in the example, we established the put position to protect against the breakdown, which happened. We bought those puts for about one put for $650. You would vary that hedge size based on the size of your portfolio. At expiration, you turned $6.50 into $29.82 to offset the loss you would have had if you had a long diamonds position. Total profit, $23.32. Again, to offset the loss in your underlying. The income generation methods. You can't generate income with stock unless you buy it and sell it. There are ways to strategically sell options as a way to generate income. Most of you have probably heard of a covered call. There's another trading strategy called a buy right, which is really just a package trade. And what do I mean by that? If someone owns stock and then at some point in the future sells calls against those, upside calls against that stock, they would call that a covered call. But if you buy the stock and sell the call as a package, if you go to the market, and again, this is much more from a market maker standpoint, you come to the floor and say, I want to do both. I want to buy the stock and sell the call. They would call that a buy right. At the end of the day, you still have the same position on. And what I'm talking about here is hedge trading, where if you own 1,000 shares of stock, you'd never sell more than 10 of the upside calls. And you're saying, well, Greg, you told me before you'd never be net naked short options. Well, yes, but if you're short 10 upside calls, but you own 1,000 shares of stock below it, in a worst case scenario, your options you have to sell the underlying at the underlying calls, the upside calls at the price that your strike price. You have 1,000 shares to cover that transaction, so ultimately your position would just wash out. So you're not doing it. And what can happen is, in some stocks, you can sell options out of the money above the, and generate a small profit. And a lot of people use that as a way to protect their downside by generating income every month. If there's a downturn in the market at some point, you've built up a bit of a war chest or a savings against possible future losses. The decaying premiums, the decay premiums from sold options can be added to the monthly income. Just noted that. And there's, again, small protection because ultimately, in our example from earlier, in the stock was trading, the XYZ stock trading at 58.53. If we had been selling the 60 calls at $2 and we had sold them for $2 in a 10 lot, so we had generated $2,000 a month. If we did that for 5 months, we would have generated $10,000. It would have cushioned the crash a little bit, but it wouldn't have fully protected us like a put would. There are other income generating strategies beyond these basics, but all of these allow you to look beyond simply up good, down bad. And as you learn more about it, you find strategies that fit your personality and your trading strategy and your capital allocation. And all these together give you many more possibilities to become a profitable trader using options. The market noise cancellation. Having an options position really does allow you to gain patience. And why is that? Because as we've talked about with buying and being the owner of calls or limited loss trades, you know going in what is your maximum loss. Absolutely positively, what is your maximum loss? I'm going to give you a personal example. Like I said, I'm not recommending you trade Google, but I had a Google butterfly on, and pardon me, I had the condor on, and so I was short a straddle, and I was long the outside puts and calls, the strangle around it. And what was happening is the position went against me recently, but because I knew exactly what my max loss was, if I had been long the stock and it was just going down and down, I wouldn't have been able to hang out. The losses would have accumulated too quickly, put too much of my capital at risk, and I would have had to have gotten out. But I knew going in what my worst case scenario, and quite honestly, about 3 or 4 days ago, the stock almost got to where it was my absolute worst case scenario. And it's one of those things where as a trader, sometimes those things happen, but there was no reason to panic because I knew I had expiration coming, and I knew in my worst case I could live with that loss. I wouldn't have been happy about it. I wouldn't have liked it a lot, but it's part of understanding you're not going to always win. Anybody who's teaching you about options and says that they've got a foolproof strategy, they always win, they're just lying to you. So in this case, personally, I knew that I was at my max loss, and I knew I had time, and there were some other things going I thought might turn this around. And the day's not over. The trade's not over. It won't be over till Friday, but we've gotten it back to where now it's turned into a bit of a winner. If I had owned that stock, and now I have an upward bias in the stock, if I had owned that stock and it was going down without any other protection, I would have had to gotten out, and I would have been stopped out and put in a serious loss. But I knew going in what my maximum loss was. I could live with that loss based on the risk reward that I had seen, and I was going to stay in the trade because I understood all of those things before I got in. So since I knew before I got in what my max loss was, and that it was a loss I was willing to live with, not that I'm ever happy about losses, but it's part of it. It's a calculated risk. I understood it, so I was able to stay in the trade. A stock position would not have afforded me that patience because it was going against me, and I probably would have had to have gotten out because I didn't know would have not have known where my losses could end up in stock. And that unknown would have caused me, at least in this case, to jump too early, to probably lock in a loss and put on a bad trade. So that patience that you gain is invaluable. Being able to understand the loss factor and the risk reward before you get in the trade. And again, it also helps you maintain positive psychology. That space between your ears can be your worst enemy or your best friend as a trader. And I think it allows you to stay positive when you can Risk is a hard thing to get your hands around, and losses can be devastating to take, but they're a little less scary if you understand up front what they can be. Then there's no surprise if they arrive like they did for me earlier, I guess late last week. I knew where I was. I wasn't happy about it. I wasn't jumping up and down. I wasn't happy, but I understood it, and the understanding part takes a little bit of the mystery out of it. You really can use the options model to your advantage. Time can be discounted. There's a availability for you to profit while trading and using options to your advantage. Time can be on your side or it can be your enemy. You can find out where it's discounted and where it's not. Finding these things allows you to understand the model, understand where the model has, I'm not going to say flaws, in the idea that you can beat the options pricing model, but if you understand its limitations, it can help you trade in a way that takes advantage of that. You can also stop tick watching. Trust me, you're talking to a guy who spent the better part of 10 years staring at every tick of the underlyings that I traded all day, every day. And it's much more difficult to make decisions if you've set a time frame up that is, I'm in a swing trade and I'm willing to be in this trade for a week or two. It's very difficult when you're watching every single tick of the underlying stock. And part of it's because if you don't have an options position, you're at risk at every single tick of the underlying stock, and you don't know where that risk could go. So out of self-preservation, you have to keep an eye exactly on what's going on. But that's one of the beauties of options, and what it does is it allows you, as somebody who has to maybe can't trade full time, but you can put on an options position, you can go to work wherever that may be. You can keep an eye on the market with your, on your laptop or your desktop or your smartphone or your tablet. Keep an eye on it from a distance, checking in every once in a while. It's sort of like, if any of you are parents out there, when you first bring the first baby home, I've had the pleasure of bringing 4 of them home, but you bring the first one home, and every moment you find yourself staring at the baby. Is the baby breathing? Is it sleeping? Is she awake? You're just, every single moment of your life is consumed with what's the baby doing. And as they get older, the distance between the times you check in become farther and farther apart. By the time you get to the 4th one, my little guy, it's a shame, but you're like, oh yeah, by the way, yeah, you did go to the doctor today. How are you? As opposed to when the first one comes out. So if you can move yourself away from having to watch it every moment of the day, it lets you gain some perspective, and it allows you to go about your day, become an options trader while still doing what you do. Technology allows you to do that, and the comfort and the knowledge that you understand your risk going in makes that possible. You also have the ability to scale in and scale out with options. I touched on it earlier, but you have the ability to get into an options trade, add to it, move around, and decrease it very, very simply by either spreading or rolling, or I'll call it legging in and out of trades. The flexibility beyond the two-dimensional up good, down bad just really makes options the superior choice for anybody who wants to go beyond equities and expand their trading and their profits. So what did we talk about tonight? Why you should trade options. We talked about the capital efficiencies, the superior alternative to shorting stocks, the limited loss and risk reduction, additional means to profit with greater choice, position integrity after profit taking, timely and flexible portfolio protection, income generation methods, and market noise neutralization. All these things together give you many reasons why you should go beyond your equity trading and join us to learn more about options trading. We have options phase 1 and phase 2 recorded sessions. We will be doing live sessions, but what we're really excited about is doing our options phase 3, which is coming up October 1st and 2nd. It's going to be the last piece of our training session. It's going to be how to take all the knowledge you would have built in phase 1 and 2 and put it into action trading condors and iron condors and butterflies and strangles and straddles, and maybe we get into doing, I don't think we'll be doing boxes and jelly rolls and stuff like that, but all the advanced options trading that floor traders use, guys like myself use all the time to benefit in options trading. So I really appreciate you joining us this evening. I would hope each of you would reach out to your educational advisor at 877-70-CYBER if you have any questions about our presentation this evening. Look for information coming out. Options Phase 3 will be coming out. The recorded versions of Options Phase 1 and 2 are out there for you. So please reach out to your educational advisor, and they will help guide you towards the course that will be best for you. This is Greg McDermott for Cyber Trading University signing off. Everybody have a great evening.